What is the one thing the TSP still won't let you do that is a big deal and could cost you thousands? My name is Mel Stubbs, and I'm here on behalf of Retirement Benefits Institute to talk to you today about some federal benefits and some federal planning for your retirement. The TSP Modernization Act, just enacted a little while ago, has given federal employees a lot more options with their TSP accounts. However, there is one thing you still can't do, and it is called tax planning using Roth conversions. Most federal employees have a traditional balance in their TSP. Traditional meaning you have not paid taxes yet and you're going to pay taxes later. You do have a Roth option inside of TSP, however, you can only contribute to it. You can't do any kind of Roth conversion. A Roth conversion is where you take some traditional money, you move it to Roth, and you go ahead and pay the taxes now. Well, why is this a big deal? Why would you want to move money to a Roth? Do you think tax rates are going to go up in the future, or do you think tax rates are going to get better in the future? Most of the people I talk to have the opinion taxes are going to go up. With all the corona stimulus and all the other things that the government does, it seems like the debt keeps getting higher and higher. Do you know what the interest rate the government is paying on its debt right now? It's very little. What if interest rates go up? The government will have to pay a whole lot more money. I'm of the opinion that tax rates have to go up. If they go up, your traditional balance is subject to a lot of taxation. So what can you do about it? It's called a Roth conversion. It's taking chunks of money and moving it to Roth systematically year by year. You can see on this tax chart, this is the highest tax rates throughout the history of the United States. The worst it ever was back in 1944, 1945. The highest tax rate was 94%. Can you imagine having a 94% tax rate? That's crazy. Easy one to remember is during the 1970s, the highest tax rate was 70%. To me, also crazy. Right now, our highest tax rate is 37%. Trump's tax cuts just lowered them from 39.6%. But if you can see, historically, tax rates have been much higher. And with all the debt and the interest payments, it just seems like taxes could go up to meet historical norms. If taxes go up a lot, your traditional balance is exposed to a lot of taxation. If you believe taxes will go up, there's little you can do inside of the TSP. All you can do is contribute to Roth on your next paycheck, but you can't do anything with the balance that you have. Most of the people I talk to are closer to retirement and they have very substantial traditional balances and they have little to no Roth. It's very hard to do a lot about that. So what are some steps you can do? And why would you want to? Well, sometimes people have trouble seeing the benefit of wanting to pay taxes sooner. So let me give you the example of a 30-year mortgage compared to a 15-year mortgage. Most people understand with a 30-year mortgage, your payment is smaller, and in the end, you will pay more interest, but it's more affordable. If you switch to a 15-year mortgage, your payment is higher because you're paying the debt off faster, but in the end, you will pay less interest. Now let's add another caveat. What if you have an adjustable rate mortgage? What if the interest rate you have is going to get worse in the future? All the more reason that you're going to want to pay it off faster. Well, that's a very similar scenario to your traditional balance. I think you have an adjustable rate balance. The tax rates can change at any time, and I think taxes will get worse in the future. If you're of that same belief, you're going to want to pay that off sooner. It does mean you have to pay taxes sooner than you ordinarily would, but that's okay because we're trying to pay off the balance early so that you pay the least amount of taxes in total. Hopefully that makes a little more sense to you. So this one tax planning idea of shifting money so that you pay less in total, the TSP does not let you do anything about that. And this could cost you thousands. As an example, let's look at $1 million balance, just to make the math easy. And let's say between state and federal, you're in the 25% tax bracket. That means you don't have $1 million, you have $750,000, and the government has $250,000. Now let's just say by the time you finally start pulling money out, tax rates have gone up to 40%, not 25%. That means your balance that was $750,000 has now been lowered to $600,000, all because they changed the tax rates. That's crazy. If we can pay off the balance earlier at what you think are better rates, in the end, mathematically, it makes sense. So should you start contributing to Roth? Possibly so. Should you be planning on how to pay off your tax debt at the lowest possible rates? Absolutely. The TSP doesn't let you do that. So what can you do about it? If you have retired, you have access to your TSP and you can roll that out into an IRA. If you are 59 and a half or older and you're still working, you can roll your money out into an IRA. With an IRA, you can do these tax planning tactics. Now, should you convert everything all at once? Probably not. Whatever you convert, you are creating income. So you will be moving up the income tax bracket as you do it. There's some planning you want to do there, because if you convert too much, you might move up the tax bracket too quickly and actually pay higher taxes. So there's some planning involved in this. So if you need help with this, you need to get together with somebody that can help you. If you need help with your federal benefits and knowing exactly what your retirement pension is going to look like, what your TSP balance might look like at retirement, you're going to want to head over to retireinstitute.com, talk with them about getting a report, and then you can talk to somebody about these Roth planning tactics. All right, until next time.